Please welcome the panel on Common Sense from Uncommon Investors, moderated by Chairman of the Milken Institute, Michael Milken.
Well, good afternoon. It's May 6th, 2024, and we have an exciting session today, Common Sense from Uncommon Investors. And we are so fortunate today that these 5 fantastic investors have decided to join us today and share their wisdom over the next 5 hours. No, but we're just giving you one. So Dan, we're going to start with you. We'd like to talk, please comment on fixed income valuations versus equities, both on an absolute basis and a relative. What sectors excite you and which are of concern to you?
Sure. Maybe we'll go to slide 12.
And Dan is here representing PIMCO. For anyone that doesn't have money with any of these 5 panelists, we'll be checking with you later.
Well, thank you, Michael. It's great to be here. Maybe we'll put up slide 12. I guess a lot of people in the room are saying, wow, the PIMCO guy's saying bonds look pretty cheap. So maybe one caveat, back a few years, they weren't. In one of our most flexible strategies at the firm, we were carrying interest rate exposure of about a year and a half. 22 was quite painful for nearly all markets, almost a prerequisite for valuation to return. But I think today, after the sell-off we've seen year to date, and markets certainly did get ahead of themselves a bit towards the end of last year, we're at a point where valuation looks pretty good. And there's a lot of complex investing being discussed at this panel over the next few days. But high quality fixed income is pretty straightforward. If you're looking at a 5-year time frame, the starting yield's usually a pretty good floor for what you could expect to earn. And you'll see that on the slide here on the left. And today, even a fairly uninteresting Bloomberg US aggregate index had a yield as of the end of last week at least of about 5.3%. A pretty good yield, still a decent amount of duration in that index, but you'll see on the right-hand side, when you look at starting yields of greater than 5%, you take a look at public equity valuations under popular measures, perhaps the cyclically adjusted PE type framework or any other type of equity risk premium type argument, fixed income looks pretty attractive, certainly on a risk-adjusted basis. And I know we get this question all the time, well, what about fiscal deficits? I think we may cover those later on in the discussion. What about inflation? It's still above central bank targets. That's true, and central banks may not be done yet. We do think there's probably a 15 or 20% chance that the central bank needs to take rates higher and then keep them on hold for longer. So this may not be great for high quality fixed income, but we do think we're at a point now where it may be even worse for other asset classes. So we do think valuation looks increasingly attractive. And real quickly on on the next slide, slide 13, when you get into a more optimized portfolio, when you start looking at out-of-index exposures, you can see in some high-quality areas of the market, you can quickly get up to yields of 6 or 7%. Again, yields that are quite attractive. And I didn't include overseas bonds in the opportunity set. Looking at what's going on in other areas of the fixed income world, high-quality markets, Australia, Canada, the UK, even segments of Europe, you have economies that are weaker than here in the United States. You have fiscal situations that are stronger. And at least from a US hedge investor's perspective, you could actually exceed the yield that you're getting here in this country. So, again, going back to that floor of 5.3%, if you get a little bit more creative in the high quality space, you can quickly get up to 6 or 7% yields. And over a 5-year holding period, even a couple of real basic asset allocation shifts within sector can quickly get you up to the high single digits. So again, lots of uncertainty from here, but pretty good value in the market.
And there was a book written a number of years ago called It's Different This Time. And that book, which we featured over the years at the Global Conference, was really a tongue-in-cheek, and the author's point was it is not different. It's not going to be different this time. And as you looked at the long-term default rates on sovereign debt of developing countries, they told us we should expect it to happen again. In your eyes, is it different this time, the financial markets? And if so, what is different?
So to follow on that statement, Sir John Templeton said the most dangerous words in investing were, "This time it's different." And but if we look over a really, really long period of time, and I actually have a slide number 30, which is about 200-year-long history of the 10-year Treasury. So if you look over very long periods of time, the cycle that we find ourselves in, and for want of a better name, we're calling normalization. We've been through a 40-year bull market in bonds. We've been through the QE years, which extended that period of time. And so where we find ourselves now is in this trading range in treasuries, in a rates market in the U.S., but it's happened before. And it's happened for extended periods of time. And if you look at the long-term history of the 10-year Treasury, which runs about 4 3/4%, we're right about there, running right about 4.5 right now, and in that trading range. So when you look at that, it doesn't appear that anything's different. I would say that there are two things that are different in this particular time series. The first is the level of fiscal deficit spending in the U.S. is really quite unprecedented relative to history, especially when you think about the U.S. being at a sub 4% unemployment rate. We are seeing the government spending literally at a level that you wouldn't see outside of world wars, for example. And part of that is the leftover or overhang from COVID. We are still living in a post-COVID economy and market. And I think that is different this time, and we're seeing the overhang of it. I call it the COVID echo, which is because the spending was already earmarked. There's various spending programs that were already enacted, but we haven't actually seen the full effect of the stimulus. So this is going to continue. What is the effect of all that? Is that the cycles have extended. We've been in an inverted yield curve for the longest time period ever, about 22 months. We've seen the leading economic index in the U.S. decline and have been in negative territory for approximately the same period of time. And so the cycle isn't dead or gone, but it is definitely extended. What's interesting and maybe what's good at this particular juncture is historically when the Fed goes on pause and stops raising rates, and by the way, that is our view, that they're not going to raise rates, that inflation is still continuing its trajectory down, is a very good time for credit. And I think that's what we're seeing. I actually have to follow Dan's comments and say I agree with regard to the opportunity set in fixed income. So I think there's a lot that's the same if you go a really long period of time, but there are some very, very unique elements right now.
Tony, it's nearly impossible to pick up a financial paper today and not see a headline on tremendous investor demand for private credit as an asset class. The headlines range from favorable to skeptical. For example, a recent Financial Times headline is "The Boom in Private Equity Losing Steam." As the debate around private credit continues, what would your headline be if you were writing the newspaper on the topic of private credit today?
Well, it's interesting. So we were up here with this panel last year, Mike, and Josh played the role of saying something that was very skeptical and against the grain. And in preparing for this, I decided to take the mantle for that this year. And so I want to give everybody in the audience a trigger warning to start out. I'm going to say things that are not overtly fawning about direct lending. And so if that offends anybody, I apologize for that. But I just want to make sure people have a chance to leave. And if we could pull up first slide, slide 38. You mentioned, Mike, on your podcast yesterday that there's over 4,000 slides that were prepared for this conference. And if I have a chance to have one or two of my slides in your collective memories when you leave the conference, I would like this to be one of them. So, it's interesting, right? Davidson Kempner has a large private credit business. When I think of private credit, I think of direct corporate lending. I also think of distressed debt, which is today euphemistically called opportunistic credit. And I think of specialty lending, which includes things like asset-backed lending, venture lending, et cetera. I suspect when most of you think of private credit, you only think of direct corporate lending. And so this disconnect, dawned upon me. Why do I have a different definition in my head for private credit than other folks do in the industry? Cambridge Associates defines private credit the way that we define private credit at Davidson Kempner. And so I think this slide kind of says it all, right? The industry for private credit overall in 2014 was reasonably small, and direct lending was the smallest part of that industry. You fast forward to 2023, direct lending is by far the largest part of that industry. In fact, it's almost 2 times the size of what the entire private credit world was almost a decade ago. And you get that when you've got 40% annual CAGR in growth compared to kind of a teens annual CAGR in growth for other parts of the industry. And my fundamental thesis, which is my maybe headline for this, is that if you get to be so big, all of a sudden you are the market, right? Things that you can do a decade earlier when you can cherry pick the best loans and the best opportunities are just not possible when you're this big. And so if you go to the next slide that we have in the deck to make this point, the reality is that for the most part, and certainly for the largest part of the capital and the structure, there are still people who make $20 or $50 million loans where there may be some alpha. Borrowers, i.e. sponsors, i.e. among the most sophisticated financial parties in the world, utilize bank syndicated lending and direct lending interchangeably. So you can see sometimes in the cycle when one is cheaper, like maybe it was at the end of 2023, bank syndicated lending gets refinanced by direct lending. All of a sudden, other points in the cycle, the other one's cheaper. So you can see this over a period of time. Sometimes it's one, sometimes it's the other. If I'm a sponsor these days, I'm hiring Goldman Sachs or Centerview or a leading investment bank, and I'm playing lenders off against each other, and all of a sudden I'm getting the best deal possible. And by the way, that deal comes with no covenants, right? Or very little covenants, very little outs, right? And so if you go to the next slide, like what's the natural result of that? The natural result of that is trouble, right? There's a race to the bottom, right? So if you look at where we are today, 22% of direct lending borrowers are generating negative operating cash flow. 8% of those borrowers have cash runway of 2 years or less. And so, one of the common conversations that people ask us at Davidson Kempner is, when are we going to see all of the defaults? And the reality is they're coming and they're here. So if you go to the next slide in the slide deck, just to fast forward through, this is the second slide I have that if I hadn't asked it, if you remember, among the 4,000 slides at this conference, this is it, right? And so one of the hallmarks you hear of both bank syndicated lending and direct lending is that default rates are only going to be in the 1% to 2% range, right? And if you look over the last 10 years, starting in 2014, and you can sort of see the Fed funds rate is the green line and the blue line is default rates. They've largely been in the 1% or 2% range with a modest tick up during COVID. Although if you look at the far right-hand extreme of that, you see they're all starting to tick up, right? But let's go back to your theme, Mike, of this time it's different, right? So let's look at 2000 to 2008, right? In the 2000 to 2008 period of time, default rates really hovered much more in the 5% range, plus or minus, right? And so what's the difference between now and 2008 or 2000 to 2008? The change is interest rates and where interest rates are. So I don't know too much about calculating correlations, but my guess is the correlation between where the Fed funds rate is and where the interest rates are is very, very high. So i.e., the more interest expense that borrowers have to pay, the more likely it is they're going to default. And the more likely it is they're going to default, the more likely it is they're going to lose money. So it's not that you're going to get crushed in this asset class. It's just that you may not actually earn the double-digit returns you think you're going to earn. You actually may earn single-digit returns. You may earn lower than single-digit returns. And I would argue you're much more likely to earn those double-digit returns in specialty lending or in opportunistic credit than you are in direct lending. It's nothing against the asset class. It's just too many people are doing it at one period of time.
So, Tony, if we put that last slide back up, so part one is default rates, the one before this. The slide before this one is default rates. And then the question is, what is recovery? So default rates in themselves don't tell us the story. What is your view on recovery?
I think default recoveries will be much lower this cycle than they have been in prior cycles. And there's not a chart on this, but there are certainly statistics out on that. And there's two reasons for it. Number one, senior debt is a much larger part of capital structures than you had in the 2000 to 2008 time frame. So you don't have the same subordination in the capital structure to protect you. Number two, covenant light and no covenant loans are a thing today. In fact, 90% of the market, I think, in the syndicated side has loans like that, and a supermajority at this point of larger direct loans have that. Not all of them, and maybe not the very small ones have that. And it turns out when you don't have covenants, there's much more of an ability for borrowers to pretend and extend or engage in creditor-on-creditor violence or capital structure conflict or whatever you want to call that. You know, you're seeing that in some very large capital structures lining up right now with Altice or Bausch Health. My guess is Josh won't want to speak about it, but he's involved in one in Robert Shaw that's gotten incredibly confrontational over time. That's just the tip of the iceberg, right? If you're dealing with the most sophisticated sponsors in the world and their backs are against the wall, they're going to enforce their rights, and the rights for most equity owners in the documents are substantial, right? And that's true in both markets. It's not limited to one market or another. So that all leads to much higher severities, Mike, than you've seen in prior cycles.
So this panel has won in a number of years the best slides. So there's 125 slides prepared for this panel. You're not going to see them all, but if you just contact someone at the Milken Institute, we'll download them. And there's also, as you can sense here, competition between the panelists. So Josh, let's go to yourself. You have a lot of flexibility. You can be in public markets, you can be in private markets, you can be in equity, you can be in debt. Why don't you take a step back and address how you're seeing the current environment?
Sure. And first of all, I want to thank Tony for taking over the spoiler alert role. And I want to point out that nobody's walking out of this panel, and it has nothing to do with who's on the stage now. So let's take a step back for a second. There are four, because in trying to frame individual opportunities, we do try to do complex credit. We don't really do what Dan does. So we like to focus on the stuff that's messy and complicated and depressed and has event drivers. And if you zoom out for a second, there are four large balance sheets that are significantly over-leveraged. Corporate balance sheets, thanks to the hangover from zero interest rates and tons of PE money competing. Real estate balance sheets, thanks to zero interest rates. And I'll come to the slides in a second. Government balance sheets and bank balance sheets. If we start for a minute with corporate balance sheets, you can see that we can now go to that slide, please, that you just had there. If you look at 2010 versus today, you'll see that today 55% of sponsor-backed deals that were done in the last 5 years have debt to EBITDA well in excess of 6 times. If you look, over 5 times. If you look back in 2010, it was 24%. And that's in the context of a world of higher interest rates. So you've got just much more pervasive leverage. Second of all, if you go to the next slide, you'll see that you're facing unprecedented debt leverage and a lot of maturities coming up. I would mention that there's something like $85 billion worth of high-yield bonds in the world today that trade at a spread of over 1,000 basis points over SOFR, and something like 72 billion that trade below 70 cents on the dollar. So you have a lot to choose from. And when you talk about default rates, and we'll get into this a little bit, and I know Steve probably, because we all have shared experience in these, default rates are no longer uniform because of the extraordinary lengths to which people abandon all ethical standards in their behavior with others who are at the same level as they are at the capital structure.
So Josh, are you referring to violence on creditors?
Yeah, it's
in that
UFC
area?
rules, Mike. It's like no rules fighting. And when I was at law school, they used to tell you that every contract, whether it was a creditor contract or any contract, had an implied covenant of good faith and fair dealing. In the post-social media world, this seems to be gone. And what used to be viewed as sort of long-term relationship building, people have gotten very short-term. And so you can get 80 cents on the dollar if you're on the steering committee and not much of anything if you're not, even though you own the same bond. So it's a really rough and tumbled world out there in the world of corporate debt. I should mention that not only is there a high level of leverage, as I said, 6, 8 times on many credits, but the maturities are fast approaching, partly because of COVID. So even if you thought you were going to double EBITDA and therefore deleverage your credit and refinance, you had 2 years out of your life, or maybe even 3, robbed by COVID. So we're just getting back to levels where people thought they were going to be. So it's hard to recover. The second set is real estate balance sheets. If we go to that next slide. Real estate has a ton of maturities coming up, and not everyone locked in interest rates for 30 years. And if your basic borrowing rate goes from 3% to 6.5% or 3.5% to 7.5%, you simply can't refi the debt on your balance sheet. That's true with things that were started, the things that have been under construction for the last 2 years and now are being delivered to the market and are finding borrowing rates to be way higher than what sponsors anticipated. And it's true with older deals where there are maturities impending. And you can see there's a large number of maturities pending during 2024 if you look on that chart. And if you look at the next chart, which we're about to put up, this one that's up there now, you'll see that today lenders are being much, much more conservative. So loan to value on new CRE loans is much lower, which means if you need to refinance, you've got a gap. And by the way, the valuation's lower too. So it's even a bigger gap. And when you've got interest rates that are twice as high, that makes for a lot of distressed real estate that look like good companies with bad balance sheets. You might have a 100% full multifamily apartment in a very good market in Florida, in Arizona, in Texas, where populations are growing and there aren't many new deliveries, but you can't refinance your debt because the rates are twice as high as they used to be. And those are very interesting opportunities, and they're just starting. And they create both debt opportunities and equity opportunities. The other little bit of context when you zoom out, not only is this unprecedented level of corporate overleverage and real estate overleverage, but if you look at the next slide, you'll see that the banking system and the federal government have a lot of leverage. Commercial banks account for a very high and disproportionate amount of commercial real estate lending, and there are many regional banks that have ratios of CRE loans to equity that's something like 600% of regulatory capital. So one false move and you're out of business. These are not systematically important financial institutions per se, but it's kind of hard to rescue them when the depositors walk right in over the weekend to JP Morgan. So JP Morgan doesn't really have to rescue that institution unless the feds require them to. And finally, there's government balance sheets, and we heard about that already a little bit from Ann, but it puts pressure on refinancing when the government itself has a lot of debt that has to come to market every year. You've got debt to GDP that is on the trajectory that you see on the right. National debt is at the highest level since World War II. It's projected to reach 166% of GDP within the foreseeable future. And in addition, if you go to the next slide, you'll see that the rate of increase in debt is pretty alarming, with the last trillion added in a mere 106 days. And this puts pressure because that debt has to be refinanced. And there are other levers that they can pull at the Fed other than interest rates, but it's hard to have a lot of degrees of freedom when you have pent-up federal spending, which is inflationary, you have low unemployment, and you have debt constantly coming due and big gaps in the federal balance sheet. So to us, this forms the framework, and it means that in those over-leveraged corporate situations, which granted they're much, much more complicated, they're more bespoke, they require a lot of levels of analysis that weren't required in the old days, and in real estate, tend to be really, really interesting areas for us.
So, Steve, Golden Tree, we're now moving to you. Tony has told us that there's storm clouds on the horizon. He's going to try to figure out how to take advantage of them. Josh has told us there's nowhere to turn. Corporations, real estate, government, banks, but there's opportunities for those with liquidity.
Yep.
What are you seeing as the most attractive opportunities in credit markets today? One area you've mentioned to me is liability management exercises. What is this, and why has it become so pervasive, and what are the opportunities that are being created?
Well, Mike, it's great to be here. It's great to be back. I agreed with a lot of what was said today. So it's the so what do you do in the current environment? I do think it's generally a benign, risk-adjusted time to invest in debt, and I do think that to set the table, when you look at, call it from 2019 to 2021, rates were low, multiples were high, and covenants were pretty lax. And that caused a situation where when you look at 4 to 5 years later on the debt needs to be refinanced, where the balance sheets need to be rationalized. And that's what liability management's about. So if you turn to slide 18, I'm a believer to try and find easy first. So if something's complicated, if there's something that's easy and can be win-win, that's the first move. And so when you look at the different liability management strategies, that there are 3 strategies. One is trying to amend and extend, and that's pretty much an evergreen strategy. One is the more contentious strategy, which is up-tiering, down-tiering, which in effect means working around your covenants to take value out or to threaten to take value out to maximize the value for the equity or to negotiate against the debt. One of the interesting anecdotes, and we'll talk about this later, is cooperative agreements, which is basically the creditors saying we're going to band together and not allow that. And then the third is creating a situation where the equity sponsor will put more equity in return for the creditors agreeing to terms. So turning to slide 19, a couple of examples of this would be like Club Corp, which largest golf community center in the U.S., for-profit, Apollo deal. It's as you can imagine, COVID and a lot of these companies were difficult for certain industries. The leisure industry would be a good example, and Club Corp fell behind its expectations and earnings. Nice recovery, debt comes due. Apollo basically improves the covenants, has subordinates the payments of junior debt, which they bought most of. They also gave a big fee to roll. That debt trades at a nice premium. Turning to page or to slide 20, another example of this would be Global Medical Response. It's basically ambulance and air rescue company for people who need emergency care. This was a company, as you can imagine, also during COVID, very challenged. Good growth before COVID, good growth afterwards. KKR basically was able to convince Ares to subordinate their second lien to a preferred. KKR put significant equity in, $300 million, and the creditors agreed to terms such that the debt that was trading in the mid-60s in the call it in the third quarter in the fall is now trading close to par. And there are many other examples of this. In terms of the slide 21, here's the cooperative agreements, which is basically the response to aggressive or creditor violence that Mike gave in the prelude to calling on me. So you look at something like Carvana, which was one of the first large-scale cooperative agreements. If you look at how the equities performed and how the debts performed, both done extremely well. And this was a very difficult negotiation, but you ended up getting a win-win. So we see that in this market. I'm always thinking of what's the most interesting parts of the market, given our perspective of the environment, and this liability management kind of jumps out. One of the areas that when people don't know what's going to happen, they tend to expect the worst. And so we've noticed when you look at where the enterprise trades, when you mark every part, the equity, the debt, this is particularly for public companies, it trades at a significant discount when in a lot of these situations where the balance sheet needs to be rationalized.
Thanks, Steve. Let's talk about concentration and quickly answered. If I asked you in the same order, starting with you, Dan, how many different credits are you invested in? And how many would make up, say, 50% of your portfolio?
Well, across our traditional business, we have thousands of credits. Across our alternative products, far more concentrated exposure. Again, one of the ways we leverage our size are in some of the names mentioned here, where control is important. Control is especially important when you have very limited protective covenants. But one point, if I can, just to go back on something we've been talking about so far, and I'll hit it quickly on page 14. When we're talking about the lousy balance sheets, there's actually one real good balance sheet out there, and I'm looking at the 2024 Milken conference slide here, and I took you back 20 years ago. 20 years ago, back in 2004, I guess it may have started actually back in the mid-90s. Things were referred to as the golden age of mortgage credit. So I think we got to be a little careful about declaring golden ages for things. We know how that ended a few years later. I bring it up because what's going on in the single-family mortgage space, or the U.S. consumer space, and again, we're quite involved, as everyone knows, in the private asset-backed areas of the market, also pretty big in commercial real estate lending. This cycle is massively different. After all the pain that was caused by consumer lending back during the GFC, you have a near pristine environment. You've seen household leverage decline quite significantly. You have a U.S. single-family mortgage market where we've migrated to a 95% fixed rate market, so a real nice asset and liability match. The current rate that borrowers are paying today is 4%, despite the headline current mortgage rate of about 7.4%. Leverage has declined to the point where, on average, there's about 70 points of equity that the U.S. homeowner has access to. And then credit availability, that's that green line on the slide. That index, I should have run a few years earlier, was up in 900. You'll see since the collapse back during the GFC, there's been next to no credit availability in that space. And then on the right-hand side, in terms of fundamentals, there's been underbuilding. I could have put multifamily development there as well on a national basis. But the reality is there's been massive household formation and not enough supply. Truly incredible that in this world where there's leverage all over the place, the golden age of private credit is amongst us, and people are looking for more and more single B and triple C borrowers to lend to. By the way, if housing doesn't go down, bad mortgage credit will mature. If we'd ever have a recession, bad corporate credit will mature as well. But it's a real interesting setup. Now, what's happened, of course, as we know over the last few years, is that single-family homes have gone up quite significantly, on the order of 20 to 30%. And Josh, to your point earlier, multifamily on a national basis now is about 20 percentage points off the highs. I don't think that's a real number either. There's been very, very little transaction volume. So this is a situation where we've underbuilt for a decade and a half. You have a great household balance sheet. To your point, Tony, consumer lending, especially finance lending, if you're focused on value, you're not focusing on doubling, tripling AUM under management, we think it's a great opportunity. And then for patient capital to take advantage of what's going to look like a blip looking back over 5 or 10 years is to provide new capital, new lending to the multifamily sector. Sunbelt markets were meant to be resilient. You're seeing rent declines now. Higher rates are not allowing this debt to roll. It's a phenomenal area to invest on a risk-adjusted basis versus opportunities in direct corporate lower quality lending.
I would just add one point to what Dan was saying. Because loan-to-values are so low on home mortgages and people are stuck, they're locked into that house. You can't move because it's going to cost you 3 times what you're paying on your mortgage. So a lot of prime borrowers who haven't missed a single payment and don't want to screw up their credit under any circumstances say, okay, I'm stuck in my house. I'm going to have to fix the roof. I'm going to have to fix the bathroom. I'm going to renovate the kitchen. And they get a home equity loan. Well, home equity loans had such a horrific reputation from the last cycle that you can buy and securitize these things, have almost 0 default rate, even though they're technically an unsecured consumer loan. And they might be a 5-year loan or a 10-year loan or a longer loan with a lot more interest rate than a mortgage. And you securitize these, can earn very high double-digit returns on those tranches. And that's an example just taking a little pivot to the right or the left because of the kind of structure of the market, if you will.
So it's always interesting to, on the one hand, you have private credit, call it single B, call it 25 to 50 million EBITDA, which kind of strikes me as like whatever, as relatively poor value. On the flip side, and there's capital, infinite capital. On the other hand, you have real estate, which there's this broad brush, and maybe corporate, it's hard to kind of figure out commercial office buildings. But when you have so many other parts, whether it's medical, whether it's single family, and here you can get very reasonable value at the, particularly if you securitize or construction loans to some of these areas, excellent value. So it's kind of an interesting mirror, and there's no capital, or very little capital. So it's kind of so you're kind of talking about the Rogoff book of, that this time is different. What isn't different is where there's no capital is usually the opportunities.
So I think this is an important point. We've talked, and Josh put up, corporations are leveraged and facing higher interest rates. Real estate is leveraged, facing higher interest rates, and government and banks. But I think what Dan has put on the table here for this discussion is we have controls on banks and lending to real estate today, and the individual consumer, homeowner, owner of single-family home real estate or condominiums has built significant value, and the net worth of people in the United States is at an all-time high in absolute total net worth from that standpoint. Let's take a look at slide 65, and that's exactly where I wanted to go here. The impact of new capital reserve requirements on the banking system. And Tony or Ann, why don't you start? What do you see the opportunities here as these new capital reserve requirements come into play?
So what we're seeing right now is in the economy more broadly, and it's going to be made more extreme by the potential of these new capital reserve requirements, and that's bifurcation in the economy. Right now we see, as you've just mentioned, the overall total net worth of particularly the U.S. population has increased substantially. However, it's really divided among the top 50% of consumers relative to the bottom 50% of income earners in the U.S. And also, it's in large institutions that have access to capital and large banks. What we're seeing is that small and mid-sized banks, to Josh's earlier point, are very much over-levered, and they're over-levered to real estate and risk. So what we're seeing in this bifurcation is a series of sort of the most interest-sensitive part of the economy, that smaller portion, the companies under 500 employees, continues to be further at risk. And I'm concerned with the addition of potential capital charges, making this more extreme, where the large banks are going to continue to attract depositors, they're going to continue to attract assets and better opportunities for lending relative to the smaller banks in the U.S. And what we're going to continue to see, as demonstrated on this slide, is more and more bank closures and consolidation. What this does create, however, for those of us here investing in these various markets is an opportunity to deploy capital where traditional bank lending has been a participant. Some of this will be distressed, in particular in the case of real estate, as we go forward in commercial real estate. So I think that's a tremendous opportunity. One word we haven't really mentioned here today in presenting an opportunity is infrastructure investing. And in addition to the broad array of investment-grade fixed income, which performs very well at this particular time in the cycle, infrastructure investment opportunities are also very solid amongst the choices. And, relatively speaking, and you can see on slide 28, at the aggregate level, and we certainly talked a bit about the risk of credit as we've come through the cycle, there is, at the aggregate level, very strong tailwinds for corporate credit strength. As you can see on this slide, interest coverage ratio is really the highest it's ever been at the aggregate level since the 1950s. A lot of that's being driven by investment-grade issuers, but also these larger companies that have access to capital. And so I think there's a strong tailwind that will move us through this cycle of over-leverage, which I completely agree with. So I think there's still some strong opportunities for investment.
Tony, how do you see these increased in reserve requirements for banks affecting your strategy at Davis & Kempner?
Well, it's interesting. So I'll speak a little bit about that, and then I'm going to bring back my contrarian side of things for the second part of this. So, one of the questions that we get asked a lot is, everyone knows that there are a lot of zombie office buildings out there. Everyone knows that a number of banks are stuck with these loans. Why aren't we seeing a lot more trading? Why aren't we seeing a lot more impairment of these loans? And my answer, which is more anecdotal than scientific, is that in a lot of cases, banks don't have enough loss reserves yet to take the losses they're going to need on these loans. And so the way you do that is you pretend and extend for a couple of years. You keep the loans on your books. You keep marking it down as a bank every year. At the magic point in the future, when the mark is lower than the sales price, you sell the loan and you can be done with it, but you're not ready to do that yet, right? So we've seen a few maybe more prominent examples of banks selling office loans, but we've also seen many more banks coming to market with loans that are 90 to 95 cents in the dollar, in some case 97 cents in the dollar. We don't do this, but if you put a gajillion % leverage in a 97 loan, you can make it into a mid to high teens rate of return, right, regardless of having a low coupon or not. And the bank can say, see, our book is good. We sold it at 90, 95, no problems here, go away. And so this game takes a long period of time. Look, if you're an owner of one of these properties, it's not so bad. The bank has sort of told you they need you, right, to actually do the work. They can't operate the office building or deal with the office building. And I'm using an extreme example of an asset class. The reason I think you've seen less of this in multifamily is there's a much more liquid market for selling multifamily on the other end. And so if the apartment complex is worth anywhere close to what the loan is, the bank will foreclose and sell you out. And so you've seen actually more defaults in what I would view as a much better asset class there. But we're seeing this play out. And, on the contrarian side, Mike, I see the converse of this when we have conversations with investors, right? And so we'll say to people, we think real estate is a really interesting opportunity. If you look at it with a 5-year period, you have to understand you're not going to bottom tick the asset class, because when opportunities come, you may find places to put work. And the first thing they'll say to us is, oh, you mean lending against real estate, right? And we'll say, yes, we lend against real estate. We think it's an interesting opportunity. But no, we actually mean buying some of these properties and asset classes that other people don't want to seem to own right now. So sometimes the conversation stops as we have no liquid capital because of our private equity issues. But often you continue to have this, this conversation, and we say, let's play out a different scenario, right? So we talked about buildings in the Southwest or California or Florida, and it's like, yeah, you might be in a lull. People built a lot the last few years. They're not building as much going forward, but the population of this country is still moving to the south and to the west, and this theme is going to continue. And let's play out a different theme, and let's play out a theme of rates actually do go down in terms of the base rate going down. Maybe it's not this year, but over the next couple of years. And then you can even play out a third theme of that happens because we actually enter into a recession, right? Which will happen one of these days. I'm not sure that's so good for corporate investments, but it may not be so terrible for your real estate investments, especially in higher quality, inflation-proof asset classes. And so, real estate tends to play out in much slower time frames than the public markets and the corporate markets. And so I think this is like a 5-year movie. It's not like a 1 or 2 year movie, but I think we're at a really interesting point in the asset class. Certainly, you see it in banks' behavior. And the difference with corporates is, you've got a maturity wall that has a little bit of duration to it, so there's always the hope that things change. You're at that maturity wall in real estate because the debt was much shorter in duration. It had tighter covenants, et cetera. And so there's less room to run. We agree with Dan, structurally, we think we're underhomed in this country by 5 or 6 million homes. And so there's a real demand story where there's just much more demand. And by the way, those homes aren't necessarily located in the right places. There are more of them in places that population is leaving and less of them in places where population is going to. And it's a lot harder to build those homes in places that population is going to with zoning restrictions and NIMBY and things like that than people think about. But that's kind of a theme we see playing out in the coming years that we're excited about.
Mike, could I answer your regulatory question there for a second on real estate? Regulations are always backward-looking and therefore usually highly ineffective. I don't think the regional banks are going to run around and make a bunch of real estate loans right now with or without higher capital requirements. But what's happened is some of the most low-risk, simple loans that large cap banks would like to make, they cannot make because of the regulations. Witness the building in Century City that's got 83% pre-leased office with a fixed price contract where you could barely get a 40% loan-to-cost construction loan. It's at a very high rate. It's ridiculous. But where there's a will, there's a way. So what we've been doing, at least to take advantage of this and do what is essentially a regulatory relief trade, is team up with major money center banks, go to their clients, make first lien loans, then we take a package of them and get back leverage on those loans from those banks. Now, those banks can't make a first lien and let us take a second lien because they have a 1.0 capital charge. But if they make a loan against a package of our loans, it's a consumer and industrial loan for some reason that I don't understand, but it is, and they take a 25-cent capital charge. So we'll end up earning 15% by leveraging the first lien a little bit with back leverage, where we would have been quite happy doing that as a second lien or as a preferred all day long, maybe even at a lower rate. So the regulations they're broad brush, they're blunt instruments, they don't really do what the regulators are intending to do, and they're almost inevitably backward looking.
So I have a file one day I'll publish, Josh, of regulators say the darndest things. And I'll never forget when they were selling McCall cellular bonds at 50 cents on the dollar. And they asked him, why are you doing that? And he said, if I knew what I was doing, I wouldn't be working for the RTC. So there are a lot of challenges. I want to talk, Dan, you launched an area that's strong, and that's home values. Equity have gone up substantially and could serve as a source of capital. I want to throw in another idea that has occurred, and that is higher interest rates and stock markets at an all-time high have had a tremendous effect on corporate pension funds. So whereas they were unfunded by hundreds of billions or $1 trillion today, overall hold today corporate pension funds, S&P 500 companies, are fully funded today. And if you're running an industrial company today and you've seen periods of time of dramatic underfunding of your pension fund, you now have a chance to get out of the financial service business by selling your pension fund asset to someone else today and selling their assets. So pension fund risk transfers are really in focus somewhat today. And that is because you've built up the value of pension funds. And there was a day that some of the major corporations, if you changed their actual assumption by 1%, you wiped out all of their earnings. Do you see this as an opportunity today to both strengthen a corporation by getting them out of the pension fund business, or for you to participate in buying these assets? Dan, what about you?
The short answer is yes, or at least help pensions de-risk. So we're seeing that theme. Obviously, we're a subsidiary of a major global insurance company and have been focused in that key area. But even at a minimum, acknowledging the fact that part of the reason we got here is rates are going higher while equity valuations have soared. You can present a lot of de-risking opportunities, cash flow-based opportunities, and arrive at a similar place. Now, again, there's a lot of variability around that base case number, like there's a lot of variability in terms of real estate fundamentals depending on location. But in general, it's been a remarkable and surprising turnaround, and it is going to lead to tremendous opportunity.
Steve, do you want to comment on that? Are you looking at credits of corporations becoming stronger because their pension funds are fully funded now rather than being underwater?
So it's always wrong way risk. You got penalized for having an undervalued pension plan, and if there was a surplus, if there was deficiency, you're always penalized, and if it's a surplus, it never counts. So now that you're in the environment where you can get out with a surplus, capture a discount, capture part of the surplus, strikes me as if that's what you're going to do, because you're not going to be recognized for the excess value and only penalized if it goes down.
All right, so our final question for the panelists, we're going to give you a chance here to be inside their commitment committee meetings of their investment department. So Tony, take us to Davis and Kempner's decision on what you're going to invest in. What happens in those meetings? Who presents the idea? Do you need universal agreement as to what you're going to do? What happens in those decisions as to what you're going to invest in?
It's a very good question to ask. And so we take a different approach with our public markets business versus our private markets business. In our public markets business, while individual teams have their own credit committee processes, if we had some firm-wide credit committee process, I think in a lot of cases we miss the opportunity to buy the paper or things along those lines. And so my belief for public markets is you want a team of folks that you've worked with, hopefully for a long period of time. You have trust in their judgment-making abilities. You've seen them make judgments over periods of time, and you want their proverbial butts on the line every time they make an investment, right? And so if they're waiting for an investment committee to make that decision, they may defer to the committee versus seeing what they have. We will then utilize committees in those processes for sizing and risk management versus the role of originally taking investment decisions. Our private markets business is quite different. We approve all investments. I approve the private market investments. The big difference between a private market investment and a public market investment is you can't undo a private market investment if you make a mistake, right? Whereas in a public market investment, you can easily undo it. We've developed something in recent years that we call, and this was named by one of my former retired partners, Scream If You Hate It, right? And the idea of Scream If You Hate It is if there's an idea that might be a little bit off-piste, but the analysts are very excited about it, don't do an initial IC on it, do a pre-meeting, and the pre-meeting is, hey, here's what we've discovered on the situation. If everything proves out, is this interesting to us? If the answer to that is no, you've saved a tremendous amount of time and effort by making people go through the effort of go to IC. But if the answer to that is yes or yes but, then continue the work and see where you are. And so our investment committees often have multiple stages to them in terms of getting approval, particularly on private investments.
And take us inside your investment committee.
So at Guggenheim Investments, we have decomposed, if you will, into 4 separate teams the investment process. And so our teams work very collaboratively with each other. We have our macroeconomic research team, our portfolio management and portfolio construction teams, and within the sector groups who are really selecting individual securities. And like Tony, we have different teams for public transactions or the more liquid markets relative to those that we originate in-house. Those teams meet frequently to review transactions, to think about the markets, and it's a very collaborative and team-based process. And those individual transactions that get reviewed often have to come back to committee multiple times, particularly on the originated transactions, to ensure that we have met our fiduciary obligation. I think it's really important with regard to our process that we are based in behavioral science, the work of Dr. Danny Kahneman. And so as a result, we really want to drive out individual investor bias and individual decision maker bias. And that's why it's so important for us to have a group of committed and knowledgeable senior leaders to review transactions and evaluate the opportunity sets at the individual sector level. This process is very iterative, and as I said, it requires a lot of very skilled legacy team members who've been with us for many years.
Thank you. Steve, take us inside Golden Tree.
So we have a variety of strategies, and each strategy has its own process for what gets into the portfolio in terms of its own what's the criteria for margin of safety for each, whether it's our structured products, whether it's our CLOs, whether it's our total return fund or hedge fund or distressed funds. And we're looking, they also have a difference in terms of the number of investments. Our distressed fund might have 20 investments. So that means that we're going to have, on average, maybe a 2 to 10% position. That's different than a CLO that might have 200 names. So what we're looking for is each name follows our process that we tend to want to have on the final investment decision when it's being discussed, no more than 2 pages, except for private, which it does have somewhat of an illiquid basis or a roach motel, so you have to be very deliberate about getting out. And what we focus on is relative value, fitting our process, and also the nature of our team is a very senior team. So they've been through pretty much everyone running a different industry has been through several cycles before.
Thanks, Steve. Dan?
Yeah, also a big fan, like Anna, of the behavioral finance literature, and we did a pretty significant review of our committee process a few years ago. So, for example, no longer does the chair conduct the meeting. We have an independent moderator that doesn't have a vested interest in the outcome. We measure how often people speak. They force me to speak last, or those that have more power from a decision-making perspective. And particularly on the private side of our business, or the opportunistic side, where you have very long diligence cycles, we pay particular interest to the concept of sunk costs and this desire when you're working on a deal for 6 months versus 60 minutes, the temptation to want to get that deal done, even if through the final rounds you lose important investor underlying protections. Then last but not least, we're increasingly a bottoms-up firm that adheres to top-down principles. We try to not make it we don't want to make it more difficult than it needs to be. So simple things like, where is there low leverage? Where are there short-term dislocations and long-term opportunity that just serve as guide rails for us? And I think that's important to always step away from this world where information's flying all around and just focus on a key few themes. Sometimes it's a lot more complicated than that. It is from an execution perspective, but I think it's always good to have a general path and have that path be based on value, not AUM growth, not the latest, greatest craze of that particular moment.
Thanks, Dan. Josh? Wrap it up for us.
Sure. Really elements of what a lot of people have said already, Mike. Privates obviously, again, have that aspect where they're less liquid going forward. So we tend to iterate a lot and make sure we have plenty of time at the investment committee, sometimes several meetings over time as those evolve, because you know you're going to not have the same exit opportunity. Public markets, things move real time, so sometimes it's just not convenient to have a full-blown investment committee meeting, yet you want to get started on something because something's going to trade, so you give a certain amount of discretion. Again, we have, like a lot of these folks, we have a very experienced and senior team, so we'll give them a certain amount of latitude to get started before we convene a full IC to review those things in detail. With something like a CLO where there are literally hundreds of names, we have a much more rigorous process for getting a name into the portfolio in the first place than we do for the ongoing care and maintenance of it, particularly selling it or trading it. It's just not practical otherwise. So it's kind of a hybrid. We did a big overhaul of this about almost 4 years ago already, and I think it was helpful to take that process and let it keep evolving as the opportunities evolve.
I want to thank all of you for joining us today for the 2024 Common Sense for Uncommon Investors.